Let's kick it off to our agenda. Hope you enjoyed the new agenda layout. Just kind of tries to synthesize some of the key thoughts from each section that we'll be hitting as we go along. So some macro thoughts are updated asset class rating. There is a new asset class we added to this. So hopefully you're able to pull that out. I'll certainly make note of it. What we're calling some market signals, like what are some of the signals of the market telling us, and then some comments about equities and alternatives from here. So just briefly touching on the economic situation that's in front of us, because that does inform how companies are likely to perform just in aggregate, as well as broader market conditions that help frame asset pricing. And what you can see here is, again, a very similar picture that we've reviewed. And I think this is just probably the easiest way to discern what the economy is doing, broadly speaking, and then also the direction that we're headed. And you do that by looking at both the services sector, which is the purple line, as well as the manufacturing sector, which is the orange line. And that dotted red line is any reading above that dotted red line means expansion in services like we have right now, and below means contraction. And of course, what I just alluded to there is we continue to have contraction within the manufacturing sector. That's not in and of itself catastrophic, because remember, the manufacturing sector is a much smaller part of the US economy than it was, maybe call it 50 years ago. But nonetheless, manufacturing continues to contract. We just got, before we came on today, the ISM services number for May, and you can see this is the April reading at 51.9. It was down to 50.3, I believe it was. So the trend is clearly in a deceleration in both manufacturing and services. And I think it just points to the idea that we'll have some sort of contractionary conditions within the economy sometime in maybe Q3, Q4, although Q3 is right around the corner, so more likely into Q4. Currency-wise, one of our ideas for the year was that the dollar would likely remain pretty strong, even though it was in a pretty steep decline after last year. And this is an important asset class to keep track of, because if the US dollar is in an upward trajectory for too long, that has a way of, for lack of a better term, breaking things, meaning debtor nations that have borrowed in US dollars have a harder time paying those dollars back to the creditors. And that creates some issues within the financial plumbing of the global system. And I think the fact that we declined from peaks we saw back in 2022 down to a level that was more manageable, about 100, and then bounced right off that, just indicates the dollar will still be pretty well bid. Interestingly, emerging markets have reacted pretty negatively to actually both directions of the dollar for differing reasons, where you're seeing Chinese stocks now in a very firm contractionary period, bear market yet again. And that plays well into the way we've been positioned throughout this time period, where we have a overweight to US stocks, of course, but no international exposure, and European stocks, interestingly, have been performing quite well through all this, actually similar to the S&P. A question mark that still, I think, hangs over the macro conditions is what direction the Fed is going to press monetary policy. And it's a key feature of the macro situation to keep track of, because the Fed moves the Fed funds rate, and then by extension, the Treasury bond moves along with it on the short end. And so that's what you can see here on this picture is, number one, the Fed funds rate, which is the purple line, going back to 2000, I believe. So this is a 20-year chart, or 2003. And then you can see on the orange line, the 2-year Treasury rate. And the reason I chose the 2-year Treasury rate was because that's the rate at which the market believes the Fed or the Fed funds rate will likely be over the next 2 years. So what you'll notice here more recently, yes, there have been periods where there have been divergences between these two lines, but very rare is it the case where the 2 years underneath the Fed funds rate. So I think what this suggests is, as has been our contention, is that the Fed is going to stay higher in interest rates for longer. There is a possibility now markets are pricing in now a greater than 25% chance, according to the Fed funds futures, that the Fed will raise rates again. So current Fed funds rate now is it's in these ranges now. So it's between 5 and 5.25. There is I think 25% chance now at the next Fed meeting, which is June 13th, I believe, that the Fed will raise rates yet again. So from 5.25 to 5.5. So this has always been our contention that inflation will be a little stickier than most expect. That should lead us to not taking much by way of duration exposure, but also it does have implications in other asset classes like equities or even real estate for that matter, that we'll get to a little bit later. Another kind of view of why what monetary policy is suggesting at the moment. It's created some anomalies in the bond market, as we've talked about, where the yield curve has inverted. So what you see are two different lines. One is the 10-year minus the 2-year. It's kind of a spread or difference in yield between the two. And the other one is the 10-year 3-month. So one's kind of a shorter term, short rate, another one's a little bit longer out. Both of them are suggesting, when these rates go below zero, historically, that has been a signal that a recession is on the horizon, somewhere in the neighborhood of 6 to 18 months. It's not a very precise predictor of recession, but the hit rate for both of these indicators has been pretty meaningfully high. And what you'll notice is back in July of last year, the 10-year 2-year went negative for the first time in yield or spread, and the 10-year 3-month shortly thereafter, I think it was in November, went into a negative inversion. So both of these continue to suggest recession or contractionary conditions that would potentially line up with our idea that Q4 might be about the time when that shows up. We don't know, again, with any precision, but we're certainly going to be mindful of new positioning, as this does have some influence into our decision-making process and our framework. Portfolio themes are actually very similar to what we laid out, I think, last quarter or last month for that matter, where there's still quite a bit of an expectations gap going on in the public market, public fixed income markets, which is creating some volatility. But this is just something we've been very mindful of, been able to avoid some of the potholes that have existed out there so far because of this idea. And we continue to be mindful there are expectations that may not be met with the current trajectory of either monetary policy or levels of valuation in the markets. We continue to be, I think, in a little bit of a no man's land. Yes, the S&P is higher for the year. We'll talk about that a little bit. But it's really, if you look at it, it's really only one part of the market is truly higher, which is the growth sector of the equity market. Value sector is actually negative through last Friday. There are opportunities on the horizon. We're going to talk about one of those new opportunities that we're looking at again here a little bit later, but there are some things starting to pop up that are looking much more interesting now. And that leads me to our investment ratings. I'm trying to actually make this more meaningful for everyone. So adding a few notes here for any changes. So hopefully this helps when you go back and review. If you do, get your hands on the deck. So two things. One is that I just wanted to clarify here, we do find short-term government debt, despite the fact that we had a debt ceiling issue in front of us, which now appears to be resolved. Short-term treasuries are at their highest yield in, call it almost 10 years, maybe 15 years. And that is by itself fairly attractive risk reward. So I know we're not talking about long-term government debt, of course, because we do think there's lots of risk on the horizon relating to owning any sort of duration in bonds, but certainly anything from 3 months to almost 2-year government bonds right now are our preferred holding within fixed income outside of a few other categories like muni bonds. And the higher this goes, as the Fed raises rates, the better our yield gets in those, especially those ultra short-term bond positions that we have in our portfolio. And then we did add a new category down in the alternative section, the real estate investment trusts. These have typically pulled in some equity beta, but I do think the performance difference over the last couple of years indicates that there's a little bit of a decoupling going on in the real estate sector versus other financial markets. So, we certainly want to make sure we're mindful of the opportunity set in front of us. Now, I think one thing that allowed us to put this on the kind of watch list and into a neutral position from unattractive just a few months ago is that the real estate sector as a whole has sold off pretty massively, which we'll talk about on the REIT. This is on the REIT side, not the public real estate side, not private real estate. And so just to give you a sense of what that means, office sector REITs down, so far this year are down about 25%, in addition to being down close to 30 or 40% last year. So we'll talk more about that here in just a minute. So this is that market indicator segment that we were just talking about. And I think it's useful to just pay attention to what various asset classes are telling us that have historically told us a similar picture about risk and return. So one is the stock market and the level of volatility in the stock market. That's the purple line. This is the VIX, or the volatility index. This is the scale here for the VIX. Generally, the VIX trades within a range in normal conditions where there's positive economic growth and not a debt ceiling on the horizon, things of that nature, between 13 and call it 16 or 17. And you can see, the VIX is moderated after last year being above 20 for basically the whole year, which indicates an elevated level of volatility. The VIX is now migrated quite nicely down into its historical range. That's generally a good sign for equity markets if you're going from a high volatility regime to a lower volatility regime, because it means that market participants are getting more comfortable with the level of the market and the forward-looking picture. Juxtapose that with the what high yield bonds are telling us. Now, this high yield bonds actually have been more of a predictor of equity market returns because they have a very high correlation to equities, typically somewhere in that 70 to 80% range correlation. And I think what's interesting is that the equity market itself is getting less volatile, whereas the high yield bond market is getting a little bit more volatile over the same exact period. So going back to the initial theme is they both can't be right. One of these is probably going to have to reprice. So either it's volatility in the stock market goes up, which we think is probably the next move for this series, or less likely would it be that high yield bond spreads come down, and we just don't see a reason for that to happen with contractionary conditions on the horizon. So typically accompanying a rise in equity volatility, by the way, is a broader decline in equity markets. And that would kind of line up with, a move lower, maybe into Q3 or Q4. Going to the divergences and maybe how we're positioning, you can see this is a year-to-date picture of 3 indexes. One is the S&P that's in orange, up through last Friday of roughly 11%, which is an average return for the S&P over the last 100 years. Then you have 2 other indexes, which, if you mush them together, should roughly mirror the S&P in equal weights. The Russell 1000 Growth Index, which is the purple line, up 22%. The Russell 1000 Value Index, down 0.7%. This is through last Friday. This divergence between these 2 style factors, growth versus values, it's one of the widest levels it's been going back to the year 2000. We did briefly see some of this kind of activity in 2021 coming out of COVID, where growth really skyrocketed during that period. And all this just suggests to us is that there is some risks building in the growth sector when you have this type of divergence, because it means that all segments of the stock market aren't participating in the rally, and that again, one of them likely has to adjust to get closer to a more stable situation so that markets can move forward. So again, while it's not a ring the bell moment, growth sector definitely has some momentum being pulled into it. That is, on the back of very strong earnings out of technology companies, particularly those exposed to AI. So think Microsoft or Google or even NVIDIA, a couple of which are in our equity strategy. Now, this is playing into our positioning in that we did have a slight overweight to technology across all of our portfolios. That's certainly helping performance, but again, this would likely be something we would trim back a little bit if the divergence between the two doesn't come closer together over time. All that being said, it does make sense that performance in the technology sector would be better than the rest of the economy, and here's why. Here is a picture of 2023 estimates for earnings in the S&P by sector. And you can see since the beginning of the year, earnings for the tech communication services, so think Facebook, consumer discretionary, think Amazon, and information technology, Google, Microsoft, have all risen, whereas the majority of the other sectors that actually haven't performed well, healthcare, consumer staples, financials, and energy, have all declined since the beginning of the year. So actually, because earnings are the main driver of stock market returns long term, the growth value dynamic at the moment does make some sense. But I guess it's a matter of degree, is I think where we would have some issue where does a 3% change in earnings estimates for the full year really equate to a 22% positive performance? I think that's where we would take some issue. The other thing I just wanted to touch on here, and again, this is really getting to some of the comments, the last of our comments that we had for this time, is, I think there's also some interesting dynamics at play right now within the REIT sector. So because we didn't have because there's no actually official office REIT ETF, and that's obviously ground zero for a lot of the anxiety going on within the real estate sector itself. What are we going to do with all these, empty buildings with absorption and things of that nature? Well, we wanted to create an index of office REITs to see, when there could potentially be a turn or just some leveling out and not just going straight down. And so we created what I'm calling the Gratus Office REIT Index. It's nothing super complicated. I've just, back in the disclosures, you could see all the companies in there and what that comprises. But it's basically the top 6 or 7 office REITs weighted by market cap roughly, and then put into an index. So I can run this index on demand. It's no big deal. So we started, this is a year ago picture, and wanted to compare the office REIT index to the broader S&P US REIT index. And so, main holdings in the US REIT index are now things like tower companies, industrial companies, things of that nature. So it's and data center companies are the largest holdings now in the S&P REIT index. And so we just wanted to compare, versus the broader REIT index, how's our office REITs doing? Because that could be a useful leading indicator. Well, I think, not to strain the eyes too much, but I think what we're noticing here is that after having bottomed in late March, early April, office REITs haven't made a go on to make a new low. So I think that's really important, because a lot of the bad news, what that suggests is that a lot of the bad news in the office sector may start to be priced in. And certainly things like dividend cuts, debt refinancings have been occurring all along the way. Property sales have been occurring along the way as well too. SL Green, which is the largest Manhattan office landowner, has actually been transacting in some of their portfolio where they've been selling off different buildings. So I guess what I'm saying here is that the fact that the office REIT index we created has not made a new low, despite all the headline news and challenges that this sector has faced, I think is a really encouraging sign. So for us, one of the reasons why we wanted to add REITs back onto our watch list or our asset categorization list is because of this dynamic in and of itself. So that the broader Vanguard REIT index itself is yielding above 4% now. As you can see, it's down 12 over the last 1 year, but if you stretch that back to January of 22, I think it's still down close to 35%, which, for our calculation is really not a bad starting point when you add it all up. So just wanted to make sure we called those things out because this is certainly an area that we continue to look at and find some attractive opportunities. Some of the things we've discussed today, still, I think this is a rally that's rooted in liquidity and capital flows. Certainly, there's a lot of momentum being driven in the market right now. it does make some sense that IT and some of the other sectors rooted in technology are leading the way higher. We just think there could be a little bit of an overshoot going on at the moment. So we want to be mindful of that. So that will likely show up in some of the positioning adjustments that come through in some of our stock models. Because, we have benefited from some of these up moves pretty decently. Still have a slight overweight now. I mean, it's actually getting to a much more neutral equation of liquid alternatives versus bonds. So, I know some clients say, well, at what level would you all consider moving back from alternative liquid strategies to bonds? And my response has always been somewhere between 5 and 5.5%. Would love to see the 2-year bond and 5-year bonds get out to over 5%. We're not quite there yet. So we don't want to be too hasty with our positioning adjustments, but we're definitely getting close to that. But I think it's important to say we still don't have any exposure to long duration bonds. I think that's a really big question mark right now for, what are long duration bonds going to do? Because, just going back to what happened in 2022, the TLT, which is the ETF following the 30-year bond, was down over 30%. That's a catastrophe, if you ask me. We have no exposure to long bonds, but I think, and that's because interest rates rose. I think there's still a possibility that could happen again if the government has issues, refinancing the debt. Just by way of mention, the Treasury General account, which is the checking account for the government, essentially. Now that we've depleted all the cash in our checking account as a country, now that needs to be refilled. And so the Treasury needs to now issue something like $700 billion over the next 2 or 3 months. At what levels is that debt going to go off at? We don't know, but definitely don't want to necessarily be in any long duration bonds that have some pricing sensitivity to that. And then on the private side, we still think this is an interesting opportunity for private markets. Certainly things like private credit have gotten a lot more attractive as interest rates have risen. So, floating rate private debt is trading in double-digit yields in some cases right now. We still think it's probably a little early to get very aggressive on private real estate at the moment, with cap rates likely to, find their footing here at some point. But on other trading type strategies, these are really fertile environments for those types of strategies that is starting to come through with some really attractive opportunity sets on the private side. Definitely feel free to reach out to us. Thanks for joining today. We look forward to bringing you another Market Matters here in July. So with that, have a great summer, and we'll see you soon.